Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. In this episode, we talk about energy stocks and ETFs, which are among the best performers this year. My guest today is Shiraz Mia, Director of Research at Zacks. Shiraz was an oil analyst for many years, and he's an expert on oil markets and follows this space very closely. So with Shiraz, we'll talk about the outlook for oil and also his favorite energy stocks. In the second part, I'll talk about energy ETFs that investors could look at. Joining me now is Shiraz Mia. Shiraz, welcome to the show and thanks so much for joining us.
Sure. Glad to be with you, Nina.
So crude prices are up more than 40% this year and about 80% over the past year. And we know that demand outlook continues to improve with economies around the world opening up. Everyone's flying, driving. So has supply not kept pace with this rebounding demand? Because we used to hear about this supply glut earlier, and we know that OPEC and other large oil producers had curtailed production during the pandemic in order to support prices, and they have started adding barrels back to the market. So tell us what is going on in the oil market. Why have oil prices surged?
Sure. It has come a bit of a surprise for us all, Nina. My understanding of what's going on in the market is that it's not so much actual real supply shortages, but rather more in the outlook that the market is trying to handicap as to how supplies will respond to consumption and demand a year to 2 years from now. And the background for that is that spending on upstream projects, meaning the monies companies spend to look for oil, drill for oil, and then bring it up to the ground, that has really come down over the last few years, particularly during COVID. And the overall environment in the marketplace, the capital markets that fund these energy companies, is such that people can see that the free flow of capital to the energy space will be a lot more restrictive. The free flow that was in the past will no longer be the case in the future. So the sum total of that is that just a couple of data points for you. So last year, globally on upstream projects, private companies spent close to $330 billion. That's about half of what companies spend on average annually just a few 4 or 5 years ago. The US rig count is about 50-60% below where it was in late 2018. So a lot of underspending. So it's not so much that current production cannot match current demand. It's the fear that in the outer years, if this underinvestment persists, we will have an imbalance with demand and consumption exceeding the then available supplies. And that's what's giving us the spike in oil prices.
So do you think this rally can continue? And I read an article in the Wall Street Journal recently that option traders are now betting on return of $100 oil by the end of next year. And we haven't seen that level since 2014. So do you think $100 oil is a possibility by the end of next year?
You can never rule anything out in the oil prices. There are just so many moving pieces, from pure fundamental supply-demand factors along the lines what we were discussing earlier, to other issues, extraneous issues that have a direct bearing on the demand for or the supply of oil. So the U.S. economy, the outlook for it is very, very positive, as you and your listeners know. Europe is perhaps a little behind the U.S., and then there is the rest of the world. And to the extent that we have a coordinated and in sync rebound in the global economy, and you coincide that with continued underinvestment in upstream projects, then in that scenario, I could totally see the commodity continuing to gain ground. I don't think that's a realistic scenario, so I'm not fully on board with it. Uh, I think the easier gains in terms of the commodity, those have been made already, and we should be entering a phase of consolidation where prices move between 50 and 80, depending on what the current mood in the market is about fundamental forces of supply and demand.
And some people talk about this wildcard, which is a possible return of Iranian oil supply to the market if sanctions on Iran get lifted. So, what are your thoughts if Iran is able to start producing and exporting oil? Do you think the oil prices are going to decline from here?
So it should be a favorable variable on the supply side of the equation. Now, even beyond Iran, Iraq has a very big untapped potential in growing its volumes. Russia and Saudi Arabia has capacity as well. Over the last decade to 2 decades, OPEC has been a bit on the defensive. So if we have non-OPEC spending curtailed and most of the incremental supply coming from OPEC, that will increase the clout of this cartel. And that may have implication for the global energy complex. But on the whole, whether it's OPEC or non-OPEC, in my judgment, over the next few years, we have sufficient capacity to more than meet what anyone is projecting in terms of what the demand situation will be.
Very interesting. Now, one trend that we have seen over the past few years is that investors are becoming increasingly socially and environmentally conscious, and they have been pouring a lot of money into ESG ETFs, and fund giants like BlackRock and Vanguard have also started pushing companies on climate progress. And the Biden administration is also likely to push for a transition to clean energy. And we have also seen that some of the major oil companies, they have already started investing more in renewables in order to prepare for a low carbon future. So do you think the world is ready to make a leap to clean energy in the coming years? And how will this ESG investing trend impact oil and energy companies in the coming years?
Yes, this is Nina, the biggest new variable in the global energy debate at present. I don't think there's any question now that we are moving in that direction. The question is what impact it will have on the legacy hydrocarbon producer. So you are absolutely right. The marketplace, whether it's the providers of capital or the individual company shareholders, they are forcing these companies to incorporate decarbonization or other measures in their long-term plans. And we are starting to see the effect of that in company policies. You rightly mentioned some companies, Shell, BP, a number of other European companies have outlined long-term plans uh, on the carbon usage future of these companies. We haven't really seen that much from the U.S.-based companies, but I suspect it's only a question of time, and that this ties up to the underinvestment in upstream projects development that I was mentioning earlier. Uh, the market, the capital markets that allow the Exxons and the Chevrons of the world uh, to spend as much as they feel is needed for future growth, that market has become a lot more discerning. So it's more conscious of these ESG developments. It's also conscious uh, of the growth at any cost mindset that has traditionally been the mantra for the energy space. So there is a lot more focus on cash flows, on returns on investment capital, on shareholder returns, and those trends and those requirements run contrary to a free flow of capital into E&P projects. So these are big developments. They will have significant long-term implications for these companies, and uh, yes, we are moving in that direction. We're not there yet, obviously, and for the foreseeable future, we will need hydrocarbons in our daily lives. But the movement is definitely in that direction.
Sure. So energy is the best performing sector this year, up more than 48%. Who would have thought that? And obviously, people who invested in oil and gas stocks, they have been very happy this year. But if you look at the longer term performance of these stocks, it has been quite painful for investors. Now, given the surge this year, do you think energy stocks are expensive now, or they're still worth a look since they have underperformed the broader market for the past so many years? And also, which areas of the energy market look attractive to you?
So I'll take up the first question, whether your listeners should consider energy stocks, and I strongly feel yes, they should. And it's not just a question of very bullish outlook for the underlying commodity. You don't need oil prices to go to 100 for this group to continue doing good. In fact, what I've been observing lately in looking at our own customers, that most of them are underinvested and underexposed to energy. So just purely in a portfolio context, having a diversified set of holdings in one's portfolio, I think it makes sense for most investors to have energy sector exposure, and the strong outperformance that we have seen from the group is partly just catching up to the long period of painful underperformance that you referred to, and I think there's still plenty of room for the group to give. So. The additional factor that makes me positive, Nina, is I briefly referred to the focus from the market on these companies to have more capital discipline, and for management teams and boards to remain focused on invested capital, returns on invested capital, and shareholder returns, and that's a trend that will play out for a long period of time. And we have seen historically that companies, industries, and sectors, capital intensive ones, once they get into this returns focus, that really that really shows up in positive and favorable returns in the stock market. Another factor that I should mention is the market's inflation fixation. And historically, commodity producers and commodities themselves tend to do good in a period where there is either inflation or there is fear of inflation. So that should be a factor for the group to continue doing good too. Now, getting to your question about which areas of the energy space, I think it's a question of risk tolerance. I personally have long been a big fan of the integrated oil companies. They give you a little bit of everything. They are well-run companies. The essentially energy conglomerates from upstream exploration and production to refining and then the downstream marketing in terms of the gas stations. I also like the large cap global oil field services companies. I'm referring to the Schlumbergers and the Halliburtons of the world. Both of these groups, in my judgment, are relatively less risky. One could have, again, on the less risky side and less commodity price exposure side, have exposure to master limited partnerships. They are high yielding kind of instruments. And then on the higher risk side and greater volatility side, one could look into the pure play exploration and production companies that tend to have more commodity price exposure and would fluctuate with the underlying commodities a lot more than these others would.
Yeah, I totally agree with you about investors being underinvested and underexposed to energy, myself included, because most investors, they focused mainly on technology giants over the past few years because they had been doing so well. And even investors who have their portfolios which look similar to the broader market, they are also underexposed to energy because energy is now such a small part of major indexes. It's less than 3% of the S&P 500 index, whereas technology is more than 27% of the S&P 500 index. So it definitely makes sense to look at energy stocks and increase exposure to energy, and particularly if investors are concerned about rising inflation. Now, let's talk about your energy stocks given your outlook for energy in the coming years.
So I've long been a fan of Chevron. This is a large cap super major, obviously an integrated oil company. Of the two U.S. biggies, Chevron and Exxon typically get mentioned comparably, but Chevron on balance has a bit of a growthier outlook and a bit of more commodity price leverage than Exxon. Exxon is a bit on the defensive side, so Chevron is my pick amongst the super majors. And again, as mentioned earlier, E&Ps give you more commodity price leverage. They tend to be mostly U.S. centric. You could have very high quality names in that. I've long been a fan of Pioneer. The ticker is PXD. But EOG Resources, Devon Energy, they are equally good. On the oil field service side, Schlumberger is the global benchmark for the industry as a whole. Halliburton comes in that area too. Halliburton has a bit more U.S. onshore presence in its geographic portfolio than Schlumberger. But if one has an outlook that there's been less underinvestment, and the global energy complex would be struggling to match demand and consumption over the next few years, then the industry will be leaning on these oil field service companies to help them squeeze the most out of the acreage and the fields they have. So Schlumberger and Halliburton will stand to benefit in their outlook.
Chevron, Pioneer, EOG Resources, Schlumberger, and Halliburton. All very interesting picks. Shiraz, thank you so much for joining us.
Oh, glad to be with you, Nina.
So that was Shiraz Mian. Now, if you want to look at energy ETFs, there are many available to investors. The most popular oil ETFs, the United States Oil Fund, ticker symbol USO, the ProShares Ultra Bloomberg Crude Oil Fund, ticker symbol UCO, and the Invesco DB Oil Fund, ticker symbol DBO. These use different futures strategies to track oil prices. Now, DBO and USO are up about 50% this year, and UCO, because it is leveraged, it is up more than 100% this year. But investors should remember that ETFs and ETNs that bet on oil prices using futures contracts like USO, UCO, and DBO, they are good at tracking the commodity in the shorter term, but could perform much worse than the commodity in the longer term due to contango issues. Contango means futures for distant months are more expensive than those expiring soon. So when ETFs or ETNs roll their contracts, that is, they sell expiring contracts and buy more expensive later dated ones, they suffer losses. So these ETFs, the future tracking funds, they are more suitable for active traders, for hedging or speculating, or just for short-term trading. They are not meant for retail investors who do not understand them properly. Now, for retail investors, individual investors who are trying to play the oil rebound or trying to increase their exposure to energy, it is better to invest in ETFs that hold energy companies rather than futures. So the Energy Select Sector Spider Fund, ticker symbol XLE, it is the most popular product in the space, and another very popular product is the Vanguard Energy ETF, ticker symbol VDE. Both these ETFs are market cap weighted ETFs. They hold energy companies, but because of their market cap weighting, Exxon and Chevron account for more than 40% of the portfolio. Now, both these ETFs are up they are up about 50% this year. There's another ETF very popular worth a look. It is the Spider S&P Oil and Gas Exploration and Production ETF, ticker symbol XOP. Now, this is an equal weighted ETF. Now, because of the equal weighting, it tilts away from the oil giants and towards more smaller and mid-cap companies. This has gained almost 70% this year. Now, if you want to look at an ETF which is the best performing in the space this year, it is actually an ETN, an exchange traded note, and this is a leveraged ETN. The ticker symbol is NRGU. It is the microsector US Big Oil Index 3 times leveraged ETN. So as the name suggests, this ETN provides 3 times leverage exposure to an equal dollar weighted index of the 10 largest US energy and oil companies. This is up more than 200% this year. But again, because of it being a leveraged product, this is not suitable for long-term investors. But if you want to bet on oil in the shorter term, energy companies in the shorter term, just for trading, then it is worth a look. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@saks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.